Hello everyone, welcome back to another video. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. Today, our practice question requires you to prepare three ledger accounts. The ledger accounts for cash at bank, trade receivables, and trade payables. We will prepare this ledger accounts to find out the missing items for credit sales revenue, credit purchases, and also the cash drawings. You can see the question on the left hand side of your screen, and on the right hand side we have all the workings which I'll go through and explain to you step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. Lee failed to keep a proper set of accounting records for his retail fashion shoe business. At the end of the financial year on 31 July 2024, the following information was available. So here you can see we are given some opening and closing balances at 1 August 2023 and 31 July 2024 for cash at bank, trade receivables, trade payables, inventory, and accrued and prepaid general expenses. We are also provided with the receipts and payment summary for the year, which can also be referred to as the cash inflows and outflows from the bank account, and also some other information with regards to drawings that have been made by the owner, and also discount received that we received from our credit suppliers, and lastly, the sales returns which we have got from our credit customers, and that amount is $500. The first requirement in this question is to use all the figures that we are provided and calculate the amount for drawings, total sales revenue, and total purchases of inventory. Now, the best way to solve this question is to prepare the relevant ledger accounts for each of these items. Starting with the drawings, we know that the owner has withdrawn a large sum of money from the business bank account. Therefore, it makes sense for us to prepare the cash at bank ledger account, and also because that we are given all the receipts and payments summary for the year in addition to the opening and closing balances. So let's have your attention to the right hand side where we have got all the workings. First of all, we understand that we are working with a business where the financial year starts on 1 August 2023 and ends on 31 July 2024. So in between these 12 months, whatever transactions have happened is what we are going to look into. So here we have a ledger account already prepared in advance for the cash at bank, which is constructed using the usual 5-column format, starting with the date in the first column, followed by the details in the second column. Then we have got the respective debit and credit columns, followed by lastly the net balance column. So cash at bank in itself is a current asset account. And the reason this is an asset account is because we can utilize these funds within our business for the purpose of running our operations. So these funds have economic benefits. And also when we are talking about cash at bank account being an asset account, we know that by default, all assets are to have an opening balance on the debit side, which also means when assets increase, we debit them. So you can see here on 1 August 2023, I've got the opening balance mentioned in the details column, which is also known as balance brought down. And that amount is $2,300, which is obviously a debit because cash at bank is an asset account. And by default, all assets should have an opening balance recorded on the debit side. So here you can see $2,300 debit, which we have selected for cash at bank as the balance given on 1 August 2023. Next, we need to look into all the cash inflows into our bank account and all the cash outflows out of our bank account. So starting with the cash inflows. So you can see the first information given under the receipts and payments summary is the cash sales. Cash sales refers to sales that you have made for cash, which means whenever you make a sale for cash, your balance in your bank account should automatically go up. So that is why in the ledger account, for the year ended 31 July 2024, we know our balance for cash at bank will go up whenever we are making a cash sale. And in this case, the amount of cash sale we have made is $6,600. So when we are making a cash sale, we are to debit the cash at bank account and we will be crediting the sales revenue account. So that is why at 31 July 2024, we are recording $6,600 on the debit side, which is also referring to the fact that balance in the bank account has gone up, and when assets go up, we debit them. And this only happened because of the cash sales we have made. Therefore, in the details, the relevant narration you should write for the account is sales revenue. And two debits now added with each other gives us a final balance of $8,900 debit. Okay. Next, we have receipts from credit customers of $29,200. So whenever we are getting some money from our credit customers, our balance available in the cash at bank account goes up. So therefore, we would be debiting the cash at bank account. But at the same time, we'll be crediting our trade receivables account, because trade receivables originally refers to our credit customers. And these credit customers were originally our assets. Now that they have paid us what they owed us, they do not owe us money anymore. So therefore, in our books, we have to reflect the fact that they don't owe us money anymore. So trade receivables, or the credit customers being assets, specifically current asset, now is going down in value because these guys have made their payment. And when assets go down in value, we credit them. So that is why we are crediting trade receivables, and simultaneously we are debiting cash at bank account, because we are obviously receiving the money, which is increasing the balance available in our bank account. And bank account being an asset account, when it goes up in value, is also to be debited. So that is why at 31 July 2024, we are including $29,200 on the debit column of the cash at bank account, with the relevant cross-reference in the details column being trade receivables, which refers to the fact that we've got this money from our credit customers, and now we've got more debits of $29,200, which gets added to the previous total of $8,900, and that gives us $38,100 debit at the end of this transaction. Okay? All right. So I guess we've taken care of all the receipts, which were the first two lines here. Now it's all payments. So starting with the first payment, checks issued to credit suppliers. So this is referring to payments which we have made to our trade payables, who are also known as the credit suppliers. We are making this payment because in the past we have bought inventory on credit from them. So now that we are making a payment to them, our liability or our obligation goes down. So how should we actually record this if we were to journalize this? Whenever we are making a payment to a credit suppliers, our balance available in the bank account goes down in value. And bank account, as we understand, is an asset account. So asset account, when it goes down in value, it's to be credited. So we would be crediting the cash at bank account. But at the same time, once we have made the payment to our credit suppliers, the obligation that we had towards these credit suppliers has gone down. So these credit suppliers were originally our liabilities, and by default, originally liabilities would have been credited. Now that we are making a payment, they are no longer our liabilities, and to reduce that obligation that we no longer have towards them, we have to debit them. So we debit trade payables while we credit the cash at bank account. Again, just to simplify, we are debiting the trade payables because we don't have an obligation anymore, which also refers to the fact that our liabilities have gone down. When liabilities go down, we debit them. And we are crediting cash at bank account because our balance available in our asset account has also gone down because of the payment we have made. And when assets go down, we credit it. Okay? So as you can understand, the cash at bank account in itself is to be credited. Okay? So if the cash at bank account is to be credited, then in the cash at bank ledger account, including the payment of $16,300, which I've made to my suppliers on the credit side to reflect the fact that balance is going down. And again, the relative cross-reference in the details column is the trade payables. So 16,000 credit now, 16,300 credit now is deducted from 30,100 debits, which leaves us with 21,800 debits. Okay? All right. Next, we have got general expenses paid, which is $9,500. So whenever you're making a payment, your balance available in the bank account goes down, and when assets go down, we credit it. So we understand we have to credit cash at bank account. At the same time, we will be debiting the general expenses account. But in this case, since we are working with the cash at bank ledger account, we are to record the $9,500 in the credit column simply because the balance is going down because it's an asset, and when assets go down, we credit it, and the Reason this went down in value is because of the general expenses, which is what we include in the details column. So now 9,500 credit gets deducted from 21,800 debit, which leaves us with 12,300 debits. Okay. So next item we have got in the receipts and payment summary is the shop fittings that we have bought. So the shop fittings costed us a total of $4,000. So if we have used our funds in our cash at bank account, then obviously our cash at bank account is going down in value. And that reduction is reflected with a credit amount being recorded here. So $4,000, as you can see, is recorded on the credit column, with the relevant narration being the shop fittings in the details column. Okay. And again, the logic is that when you're buying shop fittings for $4,000 cash, your balance available in your bank account is decreasing, as a result of which that reduction is reflected by recording the $4,000 on the credit side, because when assets go down, we credit them. So this 4,000 credit now gets subtracted from 12,300 debit, which leaves us with $8,300 debit as the final balance at the end of this transaction. Now, the next item we have got is the drawings, which is something that we don't know and we have to figure it out for ourselves, but we'll be doing this at the end of this account. The next item after drawings is the cash purchase of inventory, which is $2,580 that we have spent. So again, you're spending money to buy inventory. So obviously your bank account is decreasing, and bank account being an asset account, when it goes down in value, is to be recorded on the credit side. So this $2,580 of inventory is recorded on the credit side of the cash at bank account, with the relevant cross-reference in the details column being the inventory account. So now 2,580 credits gets deducted from 8,300 debits, which leaves us with $5,720 debit. Okay. Now, so to find out drawings, what's the step? So I'm going to erase some information from here so you understand what's going on. So all these transactions that we have looked into within this section refers to everything that has happened during the year ended 31 July 2024. And as you can see, we have included various receipts at the beginning, followed by many payments that we have made using our funds available in our bank account. Now, we also know that the owner has made some drawings, and this is confirmed based on the additional information number 2, which says that during the year, Lee withdrew a sum of money from the business bank account for personal use. So obviously, this is referring to drawings in the form of cash that you have withdrawn from the bank account. And this is also our requirement to solve in this question. So if you look into the ending balance for the cash at bank account, which is at 31 July 2024, the ending balance is $3,490 debit. So we understand the ending balance represents a current asset, which also means that we had $3,490 left in our bank account after all the events have taken place. So the ending balance at 31 July 2024 gets carried forward as the opening balance on 1 August 2024. So if you check the ledger account, which I have prepared, you will see that at 1 August 2024, I've included the opening balance, which is balance brought down of $3,490 debit, obviously reflecting an asset. Okay. This means that at the end of all the transactions at 31 July 2024, our net balance at the end of all transactions, our net balance must be $3,490 debit, which is what gets carried forward as the opening balance in the next financial year, right? So how do we go from $5,720 debit to $3,490 debit? Obviously, if we have some credits involved here, and that credit is what we need to calculate, and that is the amount which refers to the balance that has gone down due to the fact that we have made drawings. So how much is the amount for drawings, which is simply the difference between 5720 and 3490. Okay, so how much is 5720 minus 3490? Let's find it out. It's 2230. So that's the amount for drawings, cash drawings, which we have made in this year. And that is the requirement that we needed to derive from the first part of the question. Again, I'll just quickly go through this. So we know after the inventory transaction was included, we had a net balance of $5,720 debit. But based on the ending balance, which gets carried forward as the opening balance, we know that $3,490 debit is the final balance that we should have after the drawings have been taken care of. So if we were to go from 5720 to 3490, we need to find the difference that we have lost. And that difference is $2,230, which makes sense to include in the credit column, because if this is included in the credit column, only then this can be subtracted from the previous ending balance of 5,720 debits to give us a final balance of 3,490 debit. Okay? All right. So that's already taken care of. So your cash drawings is $2,230. All right. The next requirement is to prepare the trade receivables account to find out the total sales revenue. We will prepare this account to calculate the credit sales revenue, and since we are given the amount for cash sales, we'll just add it with the credit sales to arrive at the total sales. So let's see how we can construct the ledger account for trade receivables. Before we start with this account, who are the trade receivables? The trade receivables refer to the credit customers of the business. These are the people to whom the business has made sales in the past on credit, and these customers have made a promise to repay us back in the future, which means that these customers are originally our current assets. All right. Now, by default, all assets should have an opening balance on the debit side, which also means that when assets increase, we record them on the debit side. So here I have the usual 5-column format for the trade receivables ledger account. And we're going to start with the opening balance at 1 August 2023, which is given at the very beginning of the question. You will see right underneath the balance for cash at bank at 1 August 2023 that trade receivables have a balance of 8,700. So this is the opening balance we included on 1 August 2023. And obviously it's a debit balance because we're dealing with assets, and by default, all assets should have an opening balance on the debit side. Next, we need to refer to all the transactions that we have got specific for trade receivables or credit customers. Okay. Now, if you check the receipts and payments summary carefully, the one transaction that relates to credit customers, right, I'm just about to highlight in green, it's the receipts from credit customers of $29,200. Now, whenever we have a receipt from credit customers, okay, what does this actually mean? If I want to journalize them, it means that I'm getting some money from my credit customers. All right. So if I'm getting some money, obviously the balance available in the cash at bank account goes up. So therefore, I would be debiting the cash at bank account by $29,200. At the same time, once these guys pay me off, they are no longer my assets because they have no obligation towards me. All right. Because I've already collected the cash, which means while assets are going up in value due to the funds deposited in the bank account, at the same time, our trade receivables, which is another form of current asset, is also going down in value because they no longer owe us money. So we would be crediting trade receivables simultaneously by $29,200. This is something you have already seen what we have done in the cash at bank ledger account. But now that we are doing the trade receivables ledger account, we understand that the trade receivables ledger account in itself must be credited by $29,200 with the relevant information or the cross-reference in the details column being the cash at bank. So let's see the trade receivables ledger account. You will see that at 31 July 2024, we know that we have got some payment from trade receivables, which reduces the balance. And this is also supported by the journal entry we have done here, where the trade receivables is being credited. So here you can see trade receivables is credited by $29,200, mainly because we have received money in the cash at bank account. And $29,200 credit, it gets deducted from $8,700 debit, which obviously means that now we will end up with a final balance that is more credits because we have got a substantial amount of credits compared to debits, so which is $20,500 credit. Okay. All right. Now, What else do we have? So you will see that point number 4 mentions that credit notes, all right? Credit notes issued to credit customers amounted to $500. So what do we understand by this? Credit notes are issued to customers only when they have confirmed some kind of return. And because we have issued this to a customer, obviously we are dealing with sales returns, right? So whenever we have sales returns, what's going to happen? The amount that our customers owe us is going to go down in value. We know credit customers or trade receivables are our current assets initially. Once they make any kind of payment or once they have made any kind of return, their value goes down. Therefore, assets are going down. Based on point number 4, we understand that we have issued a credit note, and credit notes are issued as a guarantee or confirmation of sales returns that we have recognized. So in this case, the sales returns is $500, which when we process, it's going to decrease the amount that our trade receivables owe us. And when trade receivables go down in value, we have to credit it because it's an asset account going down in value. So that is why $500 is recorded on the credit side, with the relative cross-reference being the sales returns account in the details column. Now, 500 credits gets added to the previous ending balance of 20,500 credits. Obviously, they're both credits, so we are adding them, which gives us a final balance of $21,000 credit. Okay? All right. Now, just hold for a moment. Let me just plug my charger in. 1 second. All right. Okay, so I've just plugged in the charger, so let's see what's going on. All right, so sales returns is already taken care of. And the reason we are preparing the trade receivables account is to find out the amount that we have sold on credit or the credit sales revenue. So how do we determine that number? So again, I'm going to erase some information and then I'm going to write them again so you understand what's going on. So after the sales returns have been processed, we understand that we have a net balance of 21,000 credit. And based on the initial balances that we are given at the beginning of the question, you will see that trade receivables have an ending balance at 31 July 2024 of $7,900. This gets carried forward as the opening balance on 1 August 2024. So you can see that on 1 August 2024, I've included $7,900 debit, obviously, because trade receivables is an asset, as the opening balance based on this information. This also means that we must end with a closing balance of $7,900 debit after all the transactions have been processed, right? So how can we go from 21,000 credit to 7,900 debit? Now, if you check the ledger account for trade receivables, one key important information is obviously missing, which is the amount that we have sold on credit, which is the main determinant of the balances, the substantial balances that you usually find in a trade receivables account. So that amount is the credit sales revenue. So obviously we have to find the credit sales revenue, which is the missing amount that we're looking for. Now, how do we go from 21,000 credit to 7,900 debit? Going from 21,000 credit to 7,900 debit means that the entire 21,000 credit needs to be offset. And after the offset is done, then we add an additional 7,900 debits on top of it, right? So how do we do it? So what we have to do in this case is add 21,000 with 7,900. And once you do that, we get 28,900, which when you include on the debit side, you will see mathematically it adds up. When you include this on the debit side, this gets deducted from the previous ending balance of 21,000 credit, which leaves us with the final balance of 7,900 debit. And the relevant cross-reference in the details column is the sales revenue account, which is also referring to the credit sales that we have made for the year ended 31 July 2024. All right. So this is a very important topic for your exam. So as you practice more and more similar types of questions, you can only get better and you can secure full marks for yourself in the main exam. All right. So the question requires us to find the total sales revenue. So the total sales revenue can be calculated by simply adding the cash and the credit sales together. So the cash sales is 6,600, which is the very first line that you can see in the receipts and payments summary. All right. Now we are adding 28,900, which we have derived from the construction of the trade receivables ledger account. And that should leave us with how much? 34,900. I think 35,500. Is it? You can check it on your end. I'll just use my calculator. I believe so is correct. So 28,900 plus 6,600. Yep, 35,500. So that is the total sales revenue, which adds the cash and credit sales together. Okay? All right. The last part is to calculate the total purchases of inventory. So based on the question, we are already provided with the cash purchase of inventory. So now we need to find the credit amount, which is what we can calculate by preparing the trade payables ledger account. Okay? So now let's look into the construction for the trade payables ledger account. So the trade payables ledger account, as you can see here on the right hand side, is already represented by the usual 5-column format. So we are starting with the opening balance on 1 August 2023. So the opening balance on 1 August 2023 is 3,860, which is given in the question. And that is what we have included as a credit balance here in the ledger account. So what's the logic? So trade payables account in itself is a current liability account. Trade payables refer to the credit suppliers of the business. These are the people from whom the business purchased inventory on credit. So obviously we have got some kind of obligation to pay these guys off, and $3,860 is what we owe them at the beginning of the year on 1 August 2023. Because these guys are my liabilities are to always have an opening balance on the credit side, and by default, it also means that whenever liabilities increase, we have to credit it. So on 1 August 2023, balance brought down of 3,860 credit, because obviously it's a liability and the opening balance is a credit. Then for the year ended 31 July 2024, let's look into the transactions from the receipts and payments summary that refer to or relate to credit suppliers. The only transaction that I can find is this one: checks issued to credit suppliers. Okay, so checks issued to credit suppliers of $16,300. So whenever we are issuing a check to our credit suppliers, we are using our funds available in our bank account. This means that the bank account decreases in value. And when bank account, which is an asset account, goes down in value, we have to credit it, because when assets go down, we credit it. So we would be crediting the cash in bank account. But at the same time, once we have made the payment to our credit suppliers, we no longer have an obligation towards these people, and our liabilities are therefore going down. When liabilities increase, we always credit them. Now that they're going down, we have to debit them. So we will be debiting the trade payables, and we will be crediting the cash at bank. So that is why in the trade payables ledger account, you can see the $16,300 of payment that I've made is recorded on the debit side, okay, with the relevant cross-reference in the details column being the cash at bank account. So 16,300 debit now gets deducted from 3,860 credits, which leaves us with 12,440 debits, because obviously we've got more debits than credits now. All right. So there are no other information concerning credit suppliers from the receipts and payments summary, but we do have another information from point number 3, which says that discount received from credit suppliers amounted to $400. So discount received is something that we get if we are making some kind of prompt payment. And discount received obviously reduces the obligation we have towards these credit suppliers, which means our liabilities are going down whenever we are receiving any kind of discount. So if liabilities are going down, we have to record this in the credit on the debit side, because when liabilities go down, we debit them. So we are recording $400 in the debit side of the trade payables account, and this $400 of reduction is mainly because we've got some discount, which is what the relevant cross-reference should be in the details column. So now this 400 debit gets added to the previous ending balance of 12,440 debits, which leaves us with the final balance of 12,840 debits. Okay? All right. So the main requirement from this question was to find out the total purchases of inventory. When we prepare the trade payables account, we can find out the credit inventory purchases. All right. Now, how do we find that? So this is the yellow highlighted line. So I'll show you how we derive it, similar to what we've done for the previous two ledger accounts. So the trade payables, which is a liability account in itself, also has a closing balance at 31 July 2024, which is 4,920. So this balance at 31 July 2024 gets carried forward as the opening balance on 1 August 2024, right? 4,920 credits. This means after all the transactions have been processed for the year ending 31 July 2024, the net balance we should eventually have is 4,920 credit. So how do we go from 12,840 debits to 4,920 credits? We need to make sure the entire 12,840 debits is first offset, and then some surplus amounts are left behind, which will eventually give us 4,920 credit. So we can go from 12,840 debit to 4,920 credit only if we have made some credit purchases of inventory, which increases our liability towards our credit suppliers. And when liability goes down, we would have recorded it as a credit. So the credit column amount is 17,760, which if you check carefully, you will see this credit can be offset against 12,840 debit to leave us with the final balance of 4,920 credits. This also means that we have bought $17,760 worth of inventory on credit from our credit suppliers. Okay? Now the question is asking you to find the total purchases, which is simply the credit purchases plus the cash purchases. So the credit purchases are what we have just determined, and cash purchases is 2,580, so which gets added to the credit purchases, and the total purchases therefore are $20,340. Okay? All right. Now, so the part B, which is very easy. So explain the term capital expenditure. So capital expenditure is simply when you buy any non-current asset, because non-current assets are bought for the purpose of generating revenue in your business, because you can utilize these non-current assets in your day-to-day operations. So capital expenditure is when you purchase a non-current asset, and also when you add value to an existing non-current asset. So what do we understand by adding value? Let's just talk about renovations. Let's think about property which we have got that is quite old. Now the property has some value in terms of the land it's on, but if you make some renovations on the inside, then it increases the value of the property, which is also some kind of capital expenditure, because when you're adding value to an existing non-current asset by doing these renovations, you're actually increasing the capacity for that property to be used for future economic purposes. All right? So therefore, capital expenditure simply means purchase of a non-current asset or adding value to an existing non-current asset. And we have been asked to identify an example from the receipts and payments summary. Again, the only moment we have actually bought a non-current asset is the shop fittings. So shop fittings purchase of $4,000 is an example of a capital expenditure, obviously because it's a non-current asset. And when you have got shop fittings in place, you can actually place all your items there for your customers to go through and check, which is again part of your daily operations or revenue generation purposes. All right? Okay. All right. So that's all for today's lesson. So we have done three things today mainly, which is to first prepare the trade receivables ledger account, followed by the cash and bank account, and then also the trade payables ledger account. We have used these accounts to determine the credit sales, drawings, and also the credit purchases. And ultimately, we have found out the total sales and the total purchases. Lastly, we looked into the definition of capital expenditure, and we found one example from the question that we are working with. So if you found value in this content, make sure to drop a like and subscribe to this channel and recommend some other topics that you need help with. Also, share this channel with your friends. And there's a link in the description to book a free Zoom call with me and discuss your online coaching and tutoring requirements so that I can help you prepare for the exams that you have at the end of October. With that being said, I'll conclude today's lesson and I'll see you in the next one.